Should you invest in this stock? That's today's video. Let's dive into it. So investing is like planting your money into something now and letting it grow over time so your future self can thank you for it. You want to choose something that's good value for money. So here are 7 basic things you should check before you invest your money. Number 1, earnings growth. Does the company have a net profit? For example, Tesla's earnings has been increasing consistently year after year for the past 3 years. 2019 was the first time it went positive. NIO, another EV company, is also following a similar trend. So the takeaway is look for steady and consistent earnings growth over time. Point number 2, stability. Is the stock price in a consistent uptrend? It is much easier to make money in the growth phase of a stock when the direction is in your favor. For example, Tesla has been consistently in an uptrend before the pandemic and has been on steroids after the rebound from the pandemic sell-off. So Tesla was and most likely still is in its growth phase. The takeaway is look for a consistent uptrend in stock price. 3, relative strength in the industry. Is the company in an industry that's booming? For example, global EV stock has increased over 40% year on year in 2019, according to International Energy Agency. Is the company also top in the industry? For example, amongst EV manufacturers, Tesla continues to be the market leader in 2019. So the takeaway is look for a top company in a growing industry. Point number 4, debt to equity ratio. How much debt does the company have for every dollar of equity? You can think of equity as how much valuable stuff the company has left after subtracting away all of their liabilities, stuff which they have to pay for. So for a low-risk company, you want low debt to equity ratio, and this varies for different industries, so check it out before you make a judgment. But the takeaway is to look for low debt to equity ratio relative to the industry you're in. Point number 5, price to earnings ratio or PE ratio. How much are people willing to pay for the stock right now? Growth stocks tend to be higher in the PE ratio because there is a higher expectation for massive growth in the future. And so you're paying a premium price for it now. On the other hand, value stocks tend to have lower PE because the market hasn't realized the company's potential yet. So that's why they're cheaper than their competitors. So the takeaway is look for companies with a high growth potential but relatively low PE. Point number 6, the management. Are the decision makers competent? Is the company innovative? Are there scandals which could negatively impact the company in the long term? Takeaway is to look for competent management with innovative products or services and good reputation. Last but not least, dividends. Does the company pay you regularly? If the company offers consistent, reasonable dividends, like for example 3%, then it indicates that the company has good stability. If the company offers very high dividends, it may be a sign of instability, so watch out. So takeaway for this is look for modest but regular and even better, increasing dividends over time. Okay, so those are the 7 points you should consider before investing your money into a stock. Here is a case study. Let's do a quick run through for all 7 points for the Coca-Cola company. Ticker symbol KO. The earnings growth. Earning has been quite consistent for the past 3 years, but not really growing. So this box would get across. Point number 2, stability. There is a consistent uptrend in the stock price. The 200-day moving average in the green here is basically going up since the beginning. So this box gets a tick. Relative strength in the industry. The beverage industry has been growing year after year and is expected to keep growing in the next 5 years. Coca-Cola is also a leader in the beverages, followed by Pepsi. So I say this box gets a tick too. Point number 4, debt to equity ratio. Coca-Cola is at 2.8 in the third quarter of 2020, which is lower than 3.3 for Pepsi. So check PE ratio. We have 25 for Coca-Cola, which is less than 26 for Pepsi, and it's also lower than the average of the beverage industry. So I would say this box is a tick too. Point number 6, management. Coca-Cola is launching beverages in emerging categories from kombuchas to cultured ciders and keto-friendly smoothies and cold brew coffees. So this gives them an edge to capture more market share. On a financial standpoint, this box would get a tick. However, it should be clear that there has long been criticism about companies' environmental impacts like depleting local water sources and plastic pollution. Okay, finally, dividends. Currently, Coca-Cola has a dividend yield of 3.41% annually. So this means that if you want to get £10 per month, you will need to invest £3,500. And Coca-Cola is also a dividend aristocrat, meaning that they have had over 25 years of dividend payout without breaking a single year. They are on their 58th year dividend streak, so that's a great track record. So that's it. Would you invest in Coca-Cola? Comment down below. If this video helped you understand more about investing in stocks, drop a like. If it didn't help, let me know too in the comments below. Don't forget to subscribe for more free content on personal finance and many more fun stuff. Let's keep growing together, and I'll see you in the next one.